Hello everyone, this is Kirk here again at OptionAlpha.com, and this is the video tutorial for option premiums. So again, we're going to go right into it and talk about some of the basics behind option premiums. So we're going to go back to our Arby's combo coupon example because I love Arby's, and this is a really easy way for you guys to understand what an option premium is. So let's just say again that we have this roast beef combo coupon for $3.99. So that's what we can buy roast beef combo right now for at Arby's. If we go in there, we'll give them the coupon, we can buy it at $3.99. Let's say that the regular cost of this combo here is $6.99 for the example. So I have this coupon in my possession, and if I want to sell it to you, add a premium onto the price that for that option contract. Remember that this is just a I'd sell it to you for $1. You would go in and pay Arby's $3.99, so your total investment would be $4.99, and the price of it regularly is going to be $6.99. So you're still going to save $2 by buying this coupon for me if you couldn't find it yourself, for example. So that's where the option premium comes into play. It's that extra price that you pay to acquire that option contract. Because again, I'm not going to give this to you for free. It has value that's left in it. So there are two main factors that determine an option contract premium. And those two factors are intrinsic value, or the value it has right now, and then the extrinsic value, the value that's remaining in time decay and volatility, etc. So we're going to go with a Apple stock example like we've been doing, and let's look at some current options that are trading for Apple. Now, I always use the last trade. So some people like to look at the bid and the ask and try to figure out what the in-between trade is. But when I'm looking at the price of an option, I'm always going to look at the last trade, or what the premium is for that particular contract. So you can see I've highlighted both of the premiums for the calls, which is located on the left side of this option pricing table, and then the puts, which is located on the right side. And you can see that there are many different prices or many different premiums because they all relate to where the strike price is in relation to the current market. So you can see that out of the money puts are trading for $758, which is $758, and out of the money calls are trading for $595, which is $595. Again, these are all the different option pricing premiums. This is what it cost to acquire any of these strike price calls and puts on Apple. So the premium isn't fixed and changes constantly. So premium you pay today is likely going to be higher or lower than premium yesterday, tomorrow. Going back to our example right here, these are the premiums as of this time. I bet you if I pull up this pricing diagram here today, and this is a couple days after I actually pulled this information that I'm making this video, that these premiums would be wildly different. And that's because the market is always changing. So everything that is a premium yesterday could be higher or lower than tomorrow. So when we talk about premiums, we want to talk about and focus on the net debit or net credit. So again, net debit means that you've spent money at the end of all of your transactions to enter the strategy. So again, this could be a debit spread, a iron condor, anything like that, a butterfly, a ratio spread, anything. Anything that you end up actually spending money on is going to be a debit spread. So to make money on these types of option strategies, there must be an increase in the value beyond the price that you paid before expiration. So that makes sense, right? If you buy a stock, the only way to make money is that the value of the stock goes up. It's the same thing with options. If you pay a premium and you actually outlay that premium as a net debit, then to make money on that option trade, you need the value of those options to go up. On the other hand, if you have a net credit, this means that you begin with a credit of money to your account. And that to make money in this option strategy, you have to have decay in value below the price you paid at or before expiration. So again, just like shorting a stock, when you short a stock, you sell it high and you want the value to go lower so you can buy it back in. The same thing applies with options trading. If you have a strategy where you actually get money at the end of the day, whether that's a credit spread, again, an iron condor, naked puts and calls, when you receive money or you receive that option premium, You can't get any more than that, but you can keep all of it if the value of those options decay and absolutely completely disappear before expiration. So that's really the two big differences between option premiums. There's going to have premiums that you outlay, and those are net debits, and then premiums that you take in, which are net credits. So again, option premiums are very, very simple. They're simply the price that you pay to enter into a contract, or the price that you receive to sell a contract or an options contract. So again, thank you for watching this video. If you guys enjoyed this video, as always, right below this video are some links to some of the favorite social networks. So please share the video with any of your friends, colleagues, or coworkers.